Hello and welcome to the fourth quarter webinar at ByteTree, where we're going to review the services, the world in markets, and a few other things as well. As always, I'm joined by Charlie Morris, the founder and CIO here at ByteTree. And before we go over to him, the first thing to say is that this is not investment advice in any way, shape, or form. That's very important to remember. We're going to cover a few things today. There's obviously the multi-asset investor, our flagship service. There's gold and silver, which Charlie covers in the Atlas Pulse Gold Report, venture, which is for pro clients only, as well as touching on bold, Bitcoin and gold ETP. We'll also have a little look at the quality portfolio as well that launched halfway through 2025. I think that takes us through the intro. And Charlie, we go over to you to talk us through world markets in Q4 2025.
Thank you, Kit, who's calling from inside a sauna by those things. So we've got last year to have a look at it. We'll kick off with stock markets, and hopefully we'll cover things. But please think about your questions, get them in, and hopefully we'll have loads of Q&A at the end. But I think what's important about stock markets last year, it was the first year we saw the US truly underperform the rest of the world, and that's the pink line. So you've got all the stock markets in the middle, gold on the top, Bitcoin on the bottom. And basically, Europe and emerging markets have all been very close, quite high, driven by China, and green we have Japan. So there's a big dispersion between US and non-US last year, and I think that has been a really powerful driver for global markets. Yeah, the point here is that 2/3 of the world index is American, 1/3 of is the rest of the world. By GDP, it's more like 25%, 75%, or 70-30, depending how you measure it. And so, there's a huge skew there. And it doesn't take much underperformance of the US to give the rest of the world a really good ride. And I think that's a very, very important high-level principle that we've got to remember. Of course, gold did really well, best year for years and years and years. I mean, certainly I've never seen a year that good before. And Bitcoin was doing fine until October, then it slumped, lagging what you expect it to do in a good year. But it slumped towards the end, which I think is reflective of really what happened in parts of the tech sector and high volatility stocks. In the bond market, I show this chart over 10 years because I think that over 1 year it's not particularly interesting. You've had US and UK yields at the top there. They're the highest in the world. The Eurozone's in red. They had been really low in 24, but they did rise last year. But the big story in bond markets really was Japan normalizing its yield curve, and then China showing its slowdown with lower yields and the sort of deflationary forces coming through there. In the UK, the blue line, we were all terrified earlier this year that UK gilts were going to blow out on budget concerns, and it hasn't happened. And I don't think it's because the budget concerns have gone away, but as I'll show you shortly, that inflation expectations have come down. So, the craziness we've had in bond markets in the last few years, it is starting to calm. And I think that people were panicking that the Japanese surge in yields was a bad thing, but it wasn't bad for American or European markets when bond yields went up. Indeed, from late 22, we had this significant bull market. So, maybe that's what we're going to see there too. Touching on inflation, starting with the USA, black is CPI. That's what actually happened. That is how inflation changed over the last 12 months. And then the other lines are 2, 10, and 30-year expected inflation. And I think the big story here is, pre-pandemic, you had this sort of stable level of around 2%. And then now we're just slightly above. And then people are very confused. Investors are very confused of whether those expectations are going to rise strongly, which I think there's a real risk of that. I mean, after all, this is happening when oil is $60. So you'd only take a small change in the price of energy to really cause these numbers to go up. And there are others who say, well, tech forces are just going to keep inflation down. It's back to normal. Who knows? But certainly they've stopped coming down below the sort of 2% level, which is what you would expect to see in a disinflationary environment. In the UK, it's very similar. Obviously, inflation during the pandemic did go higher, but those numbers are coming down. And I reiterate, which a lot of people forget, the UK prices inflation off RPI, which is 0.9% higher than CPI as a general rule of thumb. And so actually our inflation is pretty normal compared to the rest of the world. So, I think that's why bond yields in the UK didn't blow out in 2025, saved by inflation. And I think inflation is saved by low energy prices. Just to recap, our money map, how we construct portfolios at ByteTree. And, I go on about this, but it's so important. It's really the DNA of what we do. Inflation is up and down. Bond yields or the economy is left to right, so a weak economy on the left, a strong economy on the right. And essentially a normal portfolio is lots of blue and lots of red. That's what a standard 60-40 portfolio looks like. But of course, you might have some inflationary assets, or you might have some value stocks in there as well. So in the black box, obviously, we like Bitcoin at ByteTree. But in value, you've got financials, you've got commodities, you've got heavy industry. And on the risk-off side, not so much in equities, but you have got tips and linkers and things like that. So if you've got an inflationary environment, then you want to weigh in the top half, a disinflationary environment, the bottom half. Risk on the right-hand side, risk off the left-hand side. What do? Well, we tend to balance it. I have been increasing quality assets last year, not massively, not aggressively, but there's a sort of sense that while there's probably a big bubble in parts of the stock market, there's also an anti-bubble in the opposite areas, such as bonds and quality. You wouldn't let me get away with a little webinar without mentioning gold and silver. So here we are. It's a very simple argument that that you've got the price of gold over 30 years there, and silver's gone up higher again, like it did in 2011. Big question for investors is silver ahead of itself? We look at the gold silver ratio on the lower chart, and when it's high, silver's cheap, and when it's low, silver's expensive. Silver's just starting to enter expensive territory. Is it overbought? Yeah, it is. And so, on a 5-year view, I'm less bullish than I was 5 years ago when we instigated the silver trade, because at that time you could sort of say, well, it was cheap gold. You can't really say that anymore, but it's no longer expensive gold. It's just slightly overvalued gold. But we stick with it. There's a bull market here. Volatility is now picking up. So it makes sense to have a smaller position, notwithstanding the fact that, if you pyramid your position into the late move, then you might, clean up. But I think in terms of portfolio management, that's not the way we do things. So it has got riskier. There's a top coming at some point. I don't know if that was yesterday or whether it's 5 years away. Who knows? But we still have a position in silver. On the gold mining shares, I show that chart 25 years going back to the old low, $255 back in 1999. And it's quite funny how the miners have just lagged so much. Now, I'm not suggesting that they should catch up, because there was a large amount of permanent capital destruction in the financial crisis in the gold mining sector, with share issues and that sort of thing. And so, you probably want to rebase that chart back to about 2015. And still, the gold miners really have done very well, and they've started to beat the gold market over the last 10 years, but not materially. And they're leveraged, so you'd expect them to do much better. And I've got one more chart on gold, and that's just the free cash flow yield of the gold miners index, and the yield at the top. You'd expect that to be to have come crashing down if gold stocks were a bubble, and it hasn't. It's still high. And that's because cash flow generation shown in blue against the gold price below, it's just rising so quickly. But actually, if you go back to 2011, where that chart, where they sort of start to diverge, you can see that the gold mining stocks really have got a lot of good news to deliver through 2026. Really, whatever happens to the gold price, I'm talking about fundamental news, how the price of the shares reacts, another thing. But they do seem to be underpinned by very, very high profits indeed, which is exciting. So we still maintain a position there. Just to highlight one more time about US equities, this time going back to 2011, which is really when they started to take off. They're in pink at the top. I'm not sure why I chose pink for them. The colours haven't worked too well there. But basically, you've got the US on the top, EM and UK, Europe in the middle. At the bottom, you've got the bottom is emerging markets. And emerging markets are obviously going to play catch up at some point. The others are really tight in their performance. But this sort of dispersion is something we haven't seen ever, I don't think, on this scale. And it's telling us something. We know what's caused it. I mean, partly it's the high valuation of US equities compared to the rest of the world. There's a bit of that, but it's probably exaggerated. But it's the tech sector. It's the fact that the US has got a massive tech sector, and places like the UK don't have many tech at all, so or hardly any in terms of large cap. And I was going to, really sort of put some water on the fire and tell you how awful it is in stock markets, particularly in large US. And I think it's really important we understand, because if we understand this, then we understand, why I'm so glued to value investing in this cycle. So the red line is long-term interest rates. It's quite abnormal that they went as high as they did in the 1970s. Could it happen again? Well, it could, but I don't think that's the primary expectation. I think there's probably a bit more stability going forward from very, very low levels. But then in equities, we've got the valuation of the US stock market in CAPE, the cyclically adjusted PE ratio. The important bit is the cyclically adjusted. And so to do that, you have to take out the cycle. And so that's why they take an average over 10-year period. Now, when you look at recessions in the earnings line, if you just looked at the earnings of the S&P 500 in aggregate, it just completely collapses during recessions. And during the good times, it always gets ahead of itself. And so by stripping that out and taking a 10-year moving average, you get some kind of base of what to look at. And we've got the second highest reading ever on this chart, at 39.8 on the CAPE. Yeah. Kate, what do you think?
Yeah, well, I was just wondering because a question came in from a client who was asking whether, something that this does is it takes the average of the last 10-year of earnings, as you say, to sort of normalize them. But someone's asking whether the incredible profits of those big American stocks, which have grown so strongly in the last 10 years and are predicted to keep doing so, whether that slightly actually invalidates the use of what they were earning 10 years ago, whether it's actually less relevant than maybe the CAPE has been previously.
Yeah, well, it's always different this time, isn't it? So you hear that every cycle. The commodities were on a permanent plateau in 2008 and that sort of thing, and then they weren't. So margins are there to be attacked. And so if a particular business sector has extremely high margins, then the next 10 years, you're going to see everyone coming for them. And I think that's the point there. Shelley got a Nobel Prize for this. Not suggesting that means you're going to turn into alpha in portfolios, because that's not how finance works. But it's certainly a very solid way of looking at long-term data. But the next bit's the interesting bit. Yeah. So what? The PE side. What does that mean? This chart here is basically the inverse of the PE is the earnings yield. Yeah. But in this case, he's done what he calls the excess CAPE. So basically, you take the earnings yield, which is 1 over 40%, which is 2%, and then take away the risk-free, the real return. Basically, less the inflation, less the bond yield, and you end up with 1.5% on his data. And so that's a low number. He's saying that equities are going to give you 1.5% real yield at current prices. Now, the last time we had a low number was in 2000. And we had a low number in the beginning of the 70s, the Nifty 50 bubble, and then we had a low number in the 1920s. Sorry, the late 18th century and 19th century. And so this, it's not something that happens very often. Yeah, that you see this. And of course, the other time was just before the Wall Street crash. So I haven't got I should put my glasses on.
1929, that's what you're thinking of.
Yeah, 1929. So I can't actually read the numbers on the screen. That's and anyway, so that's quite interesting. I think that you've had these periods where you've got a very, very low number, and periods where you've got a high number with the blue line. And so 1982 was well known for the best time ever to buy the stock market, and before and after the war. And that's fine. There was a spike in 1932, which came about after the Wall Street crash, right, rather than before it. So those were all the times where the stock market was cheap, and then the times where the stock market was expensive when it's low. Now the green line is if you take the 10-year return backwards 10 years. So in 2015, you've got the most recent plot of the green line, yeah, and that says from 2015 we had a 15% rate of return on the S&P 500, and we don't know what the rate of return was after that because it hasn't happened yet. But that plot of the green line will continue to be to come and stay 10 years behind. But if we go back to the previous century, it's how closely 10 years of return have followed the valuation at the starting point. And it's really extraordinary how close that relationship is. And so we should be expecting a low rate of return on large cap US equities, which make up 2/3 of the world index. Yeah, that's the most important point here. Now we've got an alternative data from GMO, and I've published this a few times over the years. And this shows the 7-year forecast for what they think that equities are going to deliver based on current valuations. And the shaded ones are the low interest rate scenario. So if we go back to pre-2020 interest rates, and the normal scenario are the solid ones. And the US on the left, US large and small, negative real returns forecast by GMO, but their deep value in the US should do a bit better. There is some deep value there, energy sector and that sort of thing. And then international small caps, they think are a bit better than international large caps. And then you've got deep value and Japan small value and emerging markets, which all show higher expected returns. Now, these lines are not massively high at the moment anywhere. In 2009, for example, they were all above 12%. But I started following this data set over 20 years ago. And it's just amazing how accurate it's been in pointing you in the right direction. And if you get the sort of the 10-year idea right, or have it at the back of your mind when you're making investment decisions, that holds you in good stead for the shocks that are going to happen in that period. You don't know when, you don't know which year it's going to be, but you just know it's coming. And then finally, this is something, we talk about equity bull markets and all-time highs and these sorts of things. This is consumer sentiment. Consumer sentiment shot to pieces in 1980 when Reagan Thatcher came to power. Then there was the 1990 recession, which was a pretty awful time, the financial crisis, the pandemic, and we're there. Consumer sentiment is as bad as it's ever been. And so I think that we should be surprised that the consumer stocks are under a bit of pressure. But it's important to remember that. We've got a booming economy, then it's booming in business-to-business sectors, principally, or in commodities or something like that, or in banking. But it's not booming at the consumer level. So that's an important point to consider as well. Then the momentum chart that I drag out from time to time, which Morgan Stanley kindly have back-tested to 1999. I think their early data is a bit dodgy, but I think their last 15 years is probably quite good, probably solid data. But the point I'm making here is that momentum investing, chasing the trend, does make you an excess return over the long term. That trend is about 4.8% per year, according to their data set. But right now, we are very, very stretched indeed. So it wouldn't surprise me at all if that came back down. That's another reason why I'm in value stocks. And then I can illustrate it here with growth versus value going back to 1975, MSCI World data. Value's still ahead on that 50-year period. But by God, since 2008, we've had this downturn in value versus growth. So, growth is very, very rich compared to value at the moment. And I think that if you look at the dot-com bubble era, 2000, 2002, then you saw this enormous outperformance in value at that time, showing you it's sort of the defensive place to be when the cycle turned. So we're waiting for this. And in my opinion, in October, the NASDAQ put in possibly its price high, but certainly its relative high, and it's starting to lag the world. And I think that might continue in 2006. Although I've been doing this for long enough to know that predictions are dangerous. You just find good stocks. On to good stocks, the whiskey portfolio. What a fine year it was, and approaching 10 years. So at the end of this month, the end of January, we will have a 10-year track record, which you can see it here. It's baked in there somewhere, the grey hair. But 39% against a very strong FTSE, so 25.8, very strong year for the FTSE, the highest in all the years we've done this, and so 13% of excess return, which is great. Not as good as 2020, 31% of excess return, where we actually made money against a losing FTSE. So that's the year I'm most proud of. But 25 is a great year. So thank you, market, for that. And there are lots of reasons behind that. But obviously precious metals had a big impact. The blockchain stocks, some big winners like TBC Bank and the Prue and others, that they all made their contribution, a little bit here, a little bit there. But the centerpiece, of course, was precious metals. The annualized rate of return now is 14.7 against 8.8, which is a good, healthy 5.8% excess return, with a volatility that's very similar. So we have a good Sharpe ratio in whiskey. It gets harder to have a good Sharpe ratio as the underlying volatility of the asset class you're involved in increases. But anyway, the long-term record's starting to look pretty good, and there you have it. And another point I'll reiterate, why not so good before 2020? Well, I did this full time for 2020. That is one, makes me almost apologize for the work that I did pre-2020. I was still putting lots of effort in, but I didn't think I was full time. And I think it was also the confidence, the 5 years of doing this. And the thing about writing newsletters is you become, in the early days, you're terrified of mistakes. And it's the hardest bit. So you probably don't take as much risk as you should. And one of the things we did was go from 20 stocks, from 5% weights to 4% weights, giving a few more stocks to diversify. And the other thing was embracing the rest of the world and having more European coverage and that sort of thing. Giving me more choice to look to find ideas in. It's very hard to do well if you only keep yourself to the FTSE 100. And on that note, Metlen obviously is FTSE 100, and lots of people have written in about Hargreaves Lansdown. We're on it. We've been in touch with Metlen, and they are not happy about it. And so lots of things are happening behind the scenes. So hopefully that will be available there soon. But certainly all the other platforms trade Metlen. It was only Hargreaves Lansdown that won't do it. A FTSE 100 company that trades £5 million a day. And they've made up, the readers, clients have written in with basic, blatant lies of why they won't do it. It's quite extraordinary what they're saying. And I don't hold that platform in very high regard, to say the least. So the soda portfolio, pretty good. 19.9 against 11.7, so that's an excess return of 8.2. So some forgiveness, please, for 2023 and 4. Still need to give you a bit more to bring that back up, but we are on an upward trajectory again. What went wrong in 23, 24? It's not like the portfolios collapsed or anything like that. It was simply, I owned the yen for too long in 2023. I probably wasn't bullish enough, but it was just not owning the Nasdaq. If the review of their investing, what I should have done is have 20% of the portfolio in the Nasdaq, and then we'd have been fine. But we didn't. And I probably would find it difficult because I do find it difficult to buy really highly rated stocks. But I guess I could have bought an index fund, which would have been forgivable. But I don't think we'll need to do that again, because if these things have stopped outperforming, then no problem. We just have to go and find good investments, which is frankly what I'm quite good at. But trying to beat a crazy market that's being driven by crazy momentum in a once in a generation AI boom is not really my skill set. Annualized, we're slightly ahead, so about 1.8% a year above the balanced index, but with materially lower volatility. And the volatility numbers, when you get to low numbers, really make a difference. There's a big difference between 14 and 15 and 7 and 6. And so I'm very pleased with that. The soda portfolio is less risky than the index. And there you have it. We're starting to pull again, once again, pull away. And hopefully over the next few years, clients will be very happy with the returns from soda. And then Bold. So I have some news. On this day, this morning, we got confirmation from the London Stock Exchange that Bold will be listing in London on Tuesday morning at 8 a.m. There you have it. The official announcements will go out on Tuesday, and I'll be making some communications with ByteTree clients, and it's very exciting. We've been working on this for a long time, and trading begins on Tuesday. Now, will it go into the portfolios? I don't know. Will Hargreaves Lansdown allow people to trade it? If they don't, then it won't. But there's lots of other questions we need to ask about that, and we'll address that slowly and thoroughly over time. There's no rush to put anything in a portfolio just because we can. So I'll be looking at all those questions over the next few months and wanting everyone's feedback on what we should do. And I want to be impartial here and sit in the middle. And I'm really not in a hurry to stick bold in just because it's our own product. That's really not what I want to do. But anyway, so yes, it's listing on Tuesday. Very exciting. We're going to be making a lot of noise from Tuesday onwards. So the bold index there, going back to the 2017 high, Bitcoin in black, gold in gold, and global equities. There it is. I mean, I think that chart to me, I mean, yes, gold and Bitcoin have gone up a lot. So that's important to why gold's done well. But it's the excess return of gold. The fact it's had a smooth journey and it's ahead of Bitcoin and gold over that period. That's the magic of this little index that we created. And the other chart that I really like, which I think demonstrates it, we've got the global money supply there in red, yeah, for the G20. And there is nothing that matches it that closely. I mean, everything follows the money suppliers to some degree or another, like the global equities will. But global equities will follow the money supply 1-to-1 or 1.2 to 1. This is 5-to-1. Yeah, if you look at those axes, since 2015, the amount of money in the world has doubled, and the bold index is up 5, 6, 7 times. So it's their sort of natural leverage that you get with the bold index, blending the risk on with the risk off, which is so powerful. So I'm really excited about talking about bold again in 2026. I've sort of gone quiet on it in recent months, but it's a fascinating subject. And isn't it great that Bitcoin's down and gold's up? That's what's supposed to happen. I'm sure when I do this review in a few quarters' time, it'll be the other way around. Kit, tell us about quality.
Yeah, so we've mentioned a couple of elements of this. This launched earlier this year. We're sort of halfway through building the portfolio on our way to 24, 25 stocks, maybe in the springtime. Obviously, as concentration in a portfolio increases, fewer stocks, and as the time horizon extends further into the future, you want to be more selective. So these notes are coming out slightly ad hoc as and when we find the opportunities and have drilled into them with enough depth. So the notes are longer. They spend more time on the detail of the competitive advantage and the durability of that long into the future. These are companies we want to be able to hold with our eyes closed for 10 years. And I think at the moment, I mean, Charlie, you talked about the bubble. The bubble is sort of like the big tree in the jungle that sucks all the light away from anything else, so things struggle to grow beneath it. But as you say, if that stops outperforming, if that tree falls, the light starts shining through and there's room for everything else to grow. And we're sort of anticipating that a little bit with quality, as you mentioned, and bonds based on the money map idea. And we're focusing, I guess, on resilience at the moment. Quality takes a lot of forms. There's a lot of quality managers out there in the world at the moment talking about high margins, high growth rates, whatever's interesting right now. But for us, it's sort of heritage, long histories, durability, resilience, proof of outperformance in previous bear markets. Those are the things we're focusing on just to help our clients sleep easy with companies that they know and love and trust. So that's how quality is going. I think if you move on to the next slide, we can talk about the first stock we recommended, which is also the worst performer so far, which is just how these things go. Diageo is pretty well known to everyone, I guess, in terms of the brands it has. They have incredible heritage and incredible brand strength, not just in the UK, but in Europe, America, globally. All alcohol stocks are struggling. We feel that alcohol is thousands of years old and something that humans are going to stick to. It's not going to go away. And so when you see Diageo trading on those valuation multiples, the black line there on the bottom of the chart, back in line with the lows after the dot-com bubble, the lows during the great financial crisis of 2008, we see that as an opportunity. We see those brands staying strong. We see habits normalizing. So even though Diageo has not worked out quite as well in the first 3 months, if you start looking 18 months, 3 years out, we remain very comfortable indeed. And the story in the rest of the portfolio is healthy and happy. No major incidents to discuss. So I think that wraps up a chat about quality, and we're going to go and move on to venture now.
Yeah, I mean, I'd say on Diageo, it's a great company. The price is down, still a great company. Venture, right? Venture has had a fabulous year. And I really hate to do this and block out all the things, but it's unfair to ByteTree Pro clients who have paid just to share all the stocks. But I basically unleashed some of the ones that have been in the portfolio for a long time. And it's just been fabulous. It hasn't just been gold miners. There's been other things as well, which have done really well, which I'm pleased with. And yeah, Danieli is one I'm particularly proud of because it was a stock that no one covered, an Italian specialist steel family control company, and it had a negative enterprise value or an enterprise value close to zero when we bought it, and the shares hadn't moved for 20 years. But before the 20 years, it was a mega growth stock, and it's doing it again. So that's exciting. But what we're doing here is global opportunities. If you look at the names of the companies in it, you'd find all of them are probably a bit too small or a bit too wacky or a bit too volatile to be a whiskey stock. So I don't want people to think that venture's got the best stocks and whiskey's got the second best. It's not that at all. It's if something's normal and liquid and mainstream and easy to trade on Hargreaves Lansdown, then you know, then it goes to whiskey. Obviously, soda's mainly collective investment schemes, and quality is very large companies. So venture is all the other stuff out there that's probably not quite suitable for whiskey, and we just find good opportunities there. There's been a bit of a change this year. We were doing a sort of 1 year run where you recommend it, and after a year, we sort of try and keep the portfolio fresh this way. Now we've moved to the traditional classic method, which is run winners, cut losers. And so something could be in for a short period of time, a few months, and if it's not doing anything and we need to put something else in, then it will be cut. It's higher risk, higher reward, and we'll try and put our note out most Mondays, but we don't want to put our note out every Monday in case we can't find, if we don't find something good, then we just won't. But if we find something good, we will write it up. So basically, what happens on a Monday is that we do the global trends. This is an extract of the spreadsheet, and Rash Power Kit and I will go through all this data and see what's going on in the world and try and find opportunities. Anything for quality, anything for whiskey, any ideas for soda implications, anything for venture. Literally, this is the sort of cornerstone of the whole thing. And it's idea generation, and it's either yes or no. There's either three good ideas or none. But that's how it is. And the stock market doesn't give you a good idea at 4 o'clock each Tuesday. It's when it wants to. But like buses, they seem to come at once. A quick reminder of ByteTree services, the sort of core ones that in traditional finance. We also do crypto. We've got Robin's AAA report, Robin and Rashbow's AAA report as well, but I'm not covering them today. But basically, you could think of it, this is split by time horizon. Venture is relatively short-term investing, whiskey medium-term. I'm going to read them all out because that's quite boring. But different benchmarks, different levels of turnover. There's a fulfillment. So what do we do in venture? It's global equities. Although we did, excuse me, we did have a commodity once. We put in palladium. In whiskey, ETFs and commodities and Bitcoin is in there as well. In soda, it's mainly collective investment schemes. It did have Berkshire Hathaway, so that's a stock. And then in quality, it's straightforward global equities, different risk profiles and that sort of thing. So that's the way to understand it. And we do get questions about how do I join them all together. The starting point is soda's 40%. If you're a multi-asset investor, soda at 60 and whiskey at 40, or soda at 80 and whiskey at 20. That's pretty cautious, but that's I'm always going to give cautious advice to people, not only give advice. And if you wanted quality, you'd put that in the middle. You would have soda and then some quality and then some whiskey, and then if you wanted some venture as well, you put that after whiskey in terms of risk. Yeah. So start off with lots of soda, and then some quality, and then some whiskey, and then some venture, and that's the way to think about it, rather than the other way around. Responsible hat on, but that is the truth. So, Kit, you better get everyone ready for the Q&A. Have you got some questions?
Yeah, we do have some questions lined up. First thing to say, yeah, as on the screen, is thanks to everyone who has sent in reviews. We really appreciate them. They really help us. So as and when you feel like it, keep those coming. But for now, thanks very much to everyone who has. And yeah, Charlie, I mean, firstly, I'm sure everyone wants to say thank you for running us through that presentation. Always great to get your views. Um, we've had a few questions come in. Someone's asked about the possibility of stop losses for gold and silver, and I just wondered whether there was an opportunity to talk about stop losses, your thoughts on them in general in portfolio management.
Um, if I was a leverage trader, I'd be all over them. For the diversified investor, then I wouldn't be. I think more about position size. Yeah. So if you've got a portfolio, I mean, I think the question is probably about DCC or Harbour Energy or AB Foods today. No, I mean they don't. I think stop losses are about reducing risk of the portfolio. Yeah, so the portfolio is in trouble when it's going down at a rate of 10% a year, and there's you've got half a dozen stocks that are causing most of the problem. Then that's time to be focused on those stocks and really chop them. But when the market's healthy and you've got a few things that aren't working, well, that's just part of diversified portfolios. I'm inclined to get rid of stocks that clearly haven't worked. Sometimes a lower price is good for a stock because it's even cheaper. But if the company is deteriorating, that's bad. That's the differential there. And yeah, I mean, if we implemented stop losses all the time on everything, then I think that it would cost us a lot of money in terms of returns. They're expensive. They're an expensive habit. Occasionally, you go, "Wow, that was a really clever idea." But if every time something went to a ByteTree score of zero, yeah, for example, any investment, our turnover would double. So good companies are going down a bit. Not the time to worry. Whole market going down, worry. Yeah. Beyond that is asset allocation and diversification and all those kind of things. And the best reason to sell a stock is because you've got a better idea coming in.
Yeah, and I think if that question was about gold and silver, you've talked about how they've gone up a lot, less bullish than 5 years ago. The volatility is higher, and you've managed that through position sizes. So that's sort of a perfect example.
Yeah.
Another question along a similar theme talks about Bold obviously benefiting from the rebalancing schedule that it has. Is there a case for rebalancing of multi-asset portfolios? But I assume the answer is kind of the same as the one you just gave for stop losses, which is the management is the risk management element of that.
Yeah. Yeah. I mean, in the soda portfolio, I'm thinking about asset allocation, um, and we look through, right? So I don't bore everyone with it, but each fund or whatever we own is an allocation to somewhere, and I look through where the managers say they are, and put it all together, and if I think there's something that's skewed or I don't want it, then I do something about it. But I think what's served me quite well over the years really is just finding good ideas, finding a space for them, and if something's tiring, kick it out. And that process of keeping a portfolio fresh um, does seem to work. It's certainly in a bull market strategy, and we've been in a bull market for most of the time. For all of the time I've been doing this, with a couple of shocks here and there. And so that's worked out very well. In the bear market, it's much harder. Um, but I think what you have to do there is accept the fact that you have to just own ultra resilient assets as best you can. You have to take some pain. You can raise cash, but you can't just take it all to cash because then you'll miss the low. And this is the thing that's really hard to explain. But basically, you could lose some money in a portfolio. And then if you get the turn right, and I'm not talking about going from cash to investments, but just the capturing the rotation of the things that come through, you'll make it all back in an instant. So you can over panic about trying to make a portfolio overly resilient, which is not to say so it's this idea of you never ever let a portfolio go backwards or sell everything that's going wrong. I used to think that. I've been doing this too long to think that anymore. That's the problem. If something stacks up, so AB Foods today, the chart was good yesterday. It looked like it wanted to go higher. And I was thinking, oh, thank God we waited for all those months, and now it's going to start moving. and then you get a trading update which basically says that the consumer's really weak, and Primark's, not it's not going backwards, it's not dying, it's not going bust. It's just growing more slowly, particularly in continental Europe. And so that's the news. And you go, oh, but then the PE is low and all that sort of thing. So it's already a cheap stock, and then lots of the company is very high quality, family controlled, and that sort of thing. So it's got so many ticks. I'm pretty reluctant just to chuck that out because of a one bad statement. There are so many other things going for it. But I think we'll be more inclined to replace some of these stocks that aren't working if a better idea came in, yeah, that's suitable for whiskey. And I think Metland, for example, the reason I didn't sell anything last week was because we still had cash in the whiskey portfolio. Metland comes in, takes that cash. But I think we've only got one stock left before we need to sell something. So let's not forget that I had huge amounts of cash following the reduction in precious metals in October. So that's why I've been quite slow on chopping things. My instinct is to give things time, because most of the time that's right.
Next questions come in, and I guess it speaks a little bit to the GMO 7-year forecast that we looked at, where they offered a high yield scenario or a high interest rate scenario and a low interest rate scenario. There's always so much talk in the markets of everyone desperately wanting rates to go down because stocks go up, and it's this simple relationship. Someone asks, 10-year gilt yields could go up 7%, could fall to 3%, could stay at 5. Do you think those scenarios are hugely relevant for UK equities, or is it not the most relevant factor?
Yeah, they are. But I mean, I think most of us are amazed about how little the impact was in 2022 on the stock market of what happened in the bond market. Because we never, no one's seen that before in living memory, which is extraordinary, isn't it? For rates to go to zero, for the 30-year real rate to go to what, -3 to +2 in 1 year, and the FTSE just went, oh great. I mean, the banks liked it, so that was probably one of the positive forces on it. But stock and bond markets are different things, and the interconnection hasn't bared fruit in the last couple of years, which I think is fascinating. And don't forget, there's a real asset element to a lot of companies, and that makes them very, very different. The companies that have suffered the most because of the rise of the interest rates have been the quality stocks, and then because they are highly and the real estate stocks and the REITs, because they're highly rate sensitive sectors because they're bond like.
You talked a lot about the bubble today, the bubble in US large cap stocks. There's a lot of talk about AI. We've got a devil's advocate question here, which is really good. Covers a few points. One, firstly, that the Cape has an upward trend over time, and if you measure the current Cape of 40 against that upward trend, it's less extreme than it looks maybe on a flat chart. Another would be that this bull cycle is arguably maybe 40 months old. I don't know if they're measuring that from the bottom of the 2022 bear market, that would be about 36, or from COVID. But either way, it's not a 13, 15, 17-year one back to 2008, if you want to measure it like that. But I guess the question is it too early to bet against the end of this bull market?
Which bit of it? So I'm not betting against any bull market. I look for bull markets and jump on board. That's what I do for a living. But there's a bull market in America which I'm very cautious of. Extreme valuations in so many sectors, and so I'm very light there. And you're going to look for great companies around the world, and you just see better value in Europe and Japan than you do in America. And would you agree with that, Kit? I mean, you look at the same information I do.
Yeah, I would agree.
That's what we do. So, I mean, America can do what it wants to do, but we won't be putting money there.
Yeah, and I think you spoke to it well when you talked about the 7-year forecast, the 10-year gap between the Cape and the ultimate real returns that followed, which is to say that's not something you necessarily have to say impacts things tomorrow, next month, next week, anything like that. it takes a long time for these valuation metrics to catch up with the real returns that follow. Um, so yeah, it's a thing to be aware of, but maybe not leverage up on bets on things changing tomorrow. Um, Next question. ByteTree's portfolio approach in the multi-asset investor is powerful and essential to managing one's wealth. Is there plans to do something similar for venture and quality, which I guess speaks to maybe the tip sheet nature of venture, but I think quality we are envisaging as a portfolio strategy as well. So do you just want to speak about how you think about the multi-asset investor as a portfolio versus the other services?
Yeah, so everything's a portfolio apart from AAA and venture. I mean, AAA is sort of a portfolio, but I don't think they just do. I think they just do 25% each month, don't they? Not really a portfolio, sort of halfway between. But a tip sheet, you've seen how strong some of those venture stocks have been. I mean, how would I put anything new in without just chopping all the strong ones? So I leave that to the client to make their own decision. It's targeted at the advanced investor. People, I expect people who follow venture to know what they're talking about. We just do the hard work for them. Um, I'm sure a lot of venture clients could have found a lot of these ideas themselves because some of them really know a lot. We've got some people who have been professionals for 20 years. They just quite like the fact that they can now play golf whilst Charlie and Kit do the hard work. So we've had those comments come through, and which I think is quite amusing. But yeah, venture shouldn't be a portfolio because the whole position size dynamic comes into it. And really, what I want people to do is look at the idea flow. I want more ideas and people to sort of go, yeah, that's great, I'll do that one, but won't do that, and disagree with that. And it's not we're not trying not to be measured, we're just trying to be faster. And I think being a portfolio would slow the whole thing down, um, and 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 then I'll start bringing risk and diversification into it. I wouldn't run a portfolio unless it was diversified. That's what I do. And the venture's not diversified. It's a bunch of good ideas. There's no effort to diversify across. Well, any diversification in the portfolio is accidental because there's different geographies, but I didn't choose that. I didn't look for different geographies. I didn't look for different sectors. It's just best idea each week. And yeah, any diversification is coincidental. That should be a disclaimer, shouldn't it?
Indeed. Um, Someone's asking for new clients who come in whether they should be buying everything in Whisky and Soda all in one go or dollar cost averaging in, and again whether it's worth buying the venture stocks that have already run.
It's the age old question, and it always comes up. But the first thing is thank you for being a ByteTree client. That's fabulous and welcome. And I do understand that there's a bit of a transition you need to go through to get on board. It's easy with soda because not much is going to change anytime soon. I mean, I might do something on Tuesday that I haven't currently thought about, but other than that, it's pretty stable. So soda's easy, crack on. But in the whiskey portfolio, you can wait if you want for new ideas to come through. Um, but if you want to follow the returns of the service, then you have to match the service. There's no other way around that. And I don't think that let's say um, Hiscox or something we've owned for ages, and I don't think it's not up that much since we bought it. I mean, fine, it's great. I mean, I've got no plans to sell it anytime soon. And I don't think that something that has gone up a lot, there's no difference between someone owning silver that's gone up a lot and someone who doesn't. And I know it's riskier today, but the same logic should apply to the guy who already owns it. And therefore, what have I done? Well, I've reduced the position in silver to counter for that. Now, should I reduce it again? Well, yes. At some point I will, but I think you've got to just give these things a little bit of space to run when they are going. But new clients, I would crack on with soda. The things that if you're worried about something's already gone up, then buy the things that haven't already gone up a lot. But then the problem there is you're going to buy all the stocks that have gone down and they get down even more. So you have this problem. But if you buy the portfolio, you'll just follow the portfolio and all will be fine. And so, the picking and choosing thing brings in its own problems. Um, yeah, venture, the ones that have gone up a lot, a bit late. Anything light blue, that's fine. Dark blue, maybe it's gone too far. But what we'll do in venture, of course, is when I next believe that I mean, for example, in October when we reduced exposure to precious metals in soda very slightly in the gold, and then a bit more, much more aggressively in whiskey. All we did in venture was not worry about that at all. We just took out one stock that we said, okay, this one's no longer playing. B2 Gold in Canada. So this thing, it had done all right, but then the Mali risk and that sort of thing. So that's not playing anymore. And it was quite obvious that it wasn't. So we cut that. But basically, I'll let things run much harder in venture and be much more obsessed by position sizing in whiskey, soda, quality, and so on. And that's important. Portfolio
Um,
versus tip sheet, big difference.
it's obviously been a big few days, big last weekend, lots of geopolitical events, lots of geopolitical talk. So there's a couple of questions. One, on whether what's happening with Trump, with Venezuela, with certain other of his actions is driving commodities and gold, making US dollar reserves less relevant for foreign countries. And another is around the value proposition of oil today.
Yeah. I was listening to Jim Mellon. I got about third of the way through his podcast yesterday, and he's been chopping all his gold and silver, and he's now piling into oil. And I've heard about that. I've heard quite a lot of that. People saying oil's just the wrong price; it's just too low. And don't forget that when we started gold and silver, it was not a particularly interesting conversation in 2018, and I had reason to believe that it would be a good starting point, which has proved prescient. But on the same logic, oil's really cheap. What the hell is it doing down here? Doesn't make any sense. But I do think that the Trump economics, I don't know where he studied it, but it will work for one term. Um, is that he wants to pump the economy as hot as he possibly can, and then keep inflation at bay by keeping the oil price low. And that seems to be his magic trick. So if you can just get everyone to produce more and more oil, um, then that'll work. So I think that when it comes to natural resources, they've always been fought over. They've always been highly geopolitical, and everyone wants their own secure supply of all of these things, the metals and energy assets, and that's recognised in the markets right now. But it's also we've got a weak consumer, I think, that we've got lots and lots of money in the world, and it needs to be invested, and people don't really trust government, so bond yields are elevated, and consumer stocks are in trouble, and so and the tech's probably over, so it sort of narrows you down, and precious metals are an obvious place to go. So, but I don't know if precious metals are going to keep rallying for 10 years, or whether it's going to just be a period of high volatility, or it's a 1980, 2011 moment coming soon. It's hard to say. But what I'll do is what I do every week and day, look at things carefully and see what's changing and make best decisions. And if I suppose the best scenario really would be that gold and silver just sort of consolidate for a while and let fundamentals catch up around them. But it's still the case that China's buying gold like crazy. And whilst China's buying gold like crazy, then everyone else wants to as well. I think gold's only just overtaken foreign reserves in and overtaken the dollar, I read recently. So in central banks' balance sheets, it's become a real thing. If the central banks are underpinning it, then gold's not going down for a generation. That's the bull case here. It's not China going to wake up next week and go, oh, maybe I'll take profits. It doesn't happen like that. They strategically decided to own tons and tons and tons of gold, and that's a few 5-year plans piled up right there.
Yeah, indeed. It's interesting, obviously, Trump was mentioned in the question, but it does go back to the freezing of Russian assets that was not under Trump, that made a lot of other countries in the world think that's where we need to go, and that's where the central bank buying sort of started and has continued. We're coming up to the end of the hour.
How
So
many
just
questions are there, Kit?
there's a couple more questions left. One asked about metrics. we use to sell silver, and I think you talked about that with portfolio management and volatility, so we can move past that. Another one asks, are you mindful of the implications of foreign exchange and fees and taxes when looking at foreign stocks? So that's a straight.
I'm mindful of them, but I'm a total return investor, and I've never been a fee person. I've never worried about fees. I've never worried about broker commissions and these sorts of things. I know some people are obsessed by them. Yeah, I mean, some people would switch from a 15 basis point ETF because there's another one for 10 basis points, and there's a lot of people that think that way. But I just shows that to my mind that says, well, you find a real way to add some value. Choose a decent ETF that's actually going to go up, and then all these problems go away. Yeah, and emerging markets in particular, they will have withholding taxes and these sorts of things. It's not at the front of my mind. I'm looking to have a diversified portfolio, and if you cut all the things out that don't make perfect sense, then you end up like everyone else in boring land and have boring outcomes in your portfolio, and therefore you may as well go and track the index. I think the most important thing behind what we do is this breadth and scope of the things we look at and putting them all together. If I didn't like gold, we'd have no gold, none. We wouldn't have 10% gold or 5%. We'd have none. I love gold, so we have lots. And that's true with everything. There's nothing in the portfolio that needs to be there. Rougher capital gearing, they don't need to be there. I want them to be there because they're better at managing bonds than I am. And so they serve a purpose. But nothing is forever, and everything is flexible. And I want as much choice as I can. And to me, taxes and that sort of thing are really low on the list of what's important in investing. I mean, if they were to nickel the capital gains, that wouldn't be much fun, would it? So that would certainly put me off. But if it's a little trading friction here and there, that doesn't worry me.
Thanks. Final question. You obviously share a first name and initial with one of the greatest, oldest investors ever, Charlie Munger. But someone is asking, how long do you intend to keep doing the multi-asset investor for, Charlie?
Um, I don't know, Kit. If you stop pissing me off for a long time, a long time until you're ready to take over, Kit. You need at least 25 years, don't you?
Yeah, yeah, that was an optimistic forecast. I thought we didn't make those.
No, I don't know. I have no plans to retire anytime soon. I'm only 55. At
Perfect.
least 10 years. So we're about, so look, we'll probably do a cheeky something at the end of January just to say 10 years. Thank you, everyone. Um, and then I think at that point, I'll commit to another 10 years. Health willing.
Health willing. Well, I'm sure everyone wishes you incredibly good health in that case, Charlie. Today, as always, shows why. Um, we're also lucky for me to work with you, and lucky for all our clients to be following along with your work. Thanks again for your time today. And to all the clients who watched, hope you enjoyed, found interesting, hope you got value out of it, and hope you had a fantastic year as well. Have a great 2026. And bye from us here at ByteTree.